Good morning. Welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us today. Coming up on the show, Tyler Morty, CEO and CIO at Four Strong Global Asset Management, will be joining us for the hour. We'll also hear from Jim Jarrell, CEO and President of Linamar. Company reported sales increases despite navigating new U.S. tariff challenges. And of course, we want to hear from you this morning on First Call. Reach out with your questions on global investing. We'll have Tyler Morty answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. And of course, our email address, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Profit fell in the latest quarter at BCE, but topped analyst estimates, supported by growth in revenue and strong performance from its business and media divisions. Bell Media continues to benefit from digital streaming growth, including gains at Crave and sports streaming platforms. Bell also highlighted rapid expansion in AI-related business services. BNN Bloomberg is owned by Bell Media, which is a division of BCE. Maple Leaf Foods' first quarter sales came in ahead of expectations as the company continues to see steady momentum across its business management. They say that the results reflected disciplined execution and improved operating efficiency, with revenue growth supported by cost controls and a stronger product mix. The company is also pointing to improving margins and solid cash flow generation during the quarter. Canadian Natural Resources posted first quarter earnings that topped analysts' expectations, helped by higher production and continued strength in its natural gas operations. The energy producer saw overall output rise from a year ago, with gains in natural gas and crude oil production helping offset a slight decline in bitumen volumes. And now our top line story. U.S. stock futures are holding their gains. Oil falling for a third day, with investors watching for signs of progress toward a possible U.S.-Iran deal that could ease flows through the Strait of Hormuz. Equities remain near record highs, helped by softer inflation, a weaker dollar, and growing confidence that war-related risks to the global economy may soon fade. At the same time, markets are bracing for a powerful new wave of global capital spending. For more on this, let's bring in our guest for the hour, Tyler Morty, CEO and CIO at Four Strong Global Asset Management. And Tyler, thanks very much for joining us.
Good morning. Thanks for having
you coming
me.
in.
Yeah, no problem.
It is an interesting time right now. Global markets, where are they sitting compared to the U.S.? The U.S. is kind of on fire right now, but so are a lot of other places.
I think a sleeper, Roger, is that global markets have been outperforming in 2026. And if you look back to 2025, the top performing stock market in the world was South Korea, right?
And it was like 76% it was up or something like that?
Something like that. The one-year number is 200%, right? So if you look at let's look at the last 15 years since the global financial crisis, the lead market has always been the U.S., right? The U.S. we had that decade of slow growth, austerity, everything like that. And the lead market has been the U.S. because it produced, quite frankly, all the growth and all the corporate earnings. And the Mag 7 was the lead cohort of the stock market. So as we look forward, the U.S. is now, as of December 2024, the U.S. comprised almost 70% of the global market cap in the world. And so, we're definitely looking to global markets to kind of pick up the slack, so to speak. And I think there's a lot of opportunities around the world in terms of Europe, Asia, et cetera.
Are you surprised at how quickly Asia has bounced back from what's unfolded? Because they were the most impacted by the oil crisis.
I think the last few years we've had a variety of supply shocks. The Iran war is obviously an energy crisis, hit Asia very, very hard. I think the one thing about Asia is it's very integrated into the supply chains of AI. So you've got kind of two opposing forces. You've got the energy crisis, and then you've got AI CapEx spending. And we'll talk about this later in the program. But South Korea, Taiwan, Japan, all these countries are inextricably linked to the AI CapEx boom. And so I'm not surprised. There's so many nuances here, Roger. Like if you think about China, they've got this huge strategic reserve. They don't have an inflation problem.
They've been building that for a little while.
Building that for a while. So, I think the market is focused a lot on the supply side We all know the Strait of Hormuz controls 20% of the oil supply. The demand side, we haven't been focusing on as much, right? And so there's demand destruction as well. When oil prices go up in Asia, what do you think happens? There's carpooling, there's strategic reserves, releases, there's all these type of things. So I think the market's been sort of unduly focused on the supply side and not enough focused on the demand destruction side.
And just to stay on the supply side for one sec, do you see these countries, Japan, trying to build reserves so they're a little more ready in case something like this happens again? Has there been talk of that?
I think that's been true. Since Trump 1.0, we forget we had a trade war in 2017. I think one of the defining features of our times, right, is that the countries have built up resiliency, whether it's a strategic petroleum reserve, whether it's sort of bolstering your domestic economy, whether it's protecting your exports. So I think around the world, the sort of word is resiliency over efficiency, right? Prepare for these types of supply shocks. And, of course, this is like energy analysts have been wargaming this Strait of Hormuz thing for the last 20 years, right? And I think what they missed is that, a lot of countries are far more prepared for these types of things.
And people are willing to weather it. Okay, from now the demand side.
On the demand side?
Yeah. Well, we were just talking about the destruction.
Oh, okay. In terms of expanding on that?
Yeah.
Yeah. Well, I mean, think about this. So in the Western world, for the high income cohort, if oil prices go up, there's no, to use the economist terms, there's no elasticity to that, right? Mm-hmm. You don't change your consumption habits. If you're in a lower income country and oil prices go up by 50%, what do you think happens? People start to think, because it's such a large part of the household income, people start to do different things. So they conserve electricity and energy and carpool.
Because they're used to it.
They're used to it. This is something that we don't, in the West, we don't really think about, right? If our car costs 50% more to fill up, we're kind of bummed out, but I mean, it's not the end of the world, right? So it's different in the emerging world. So back to your earlier question, Roger, am I surprised on the resiliency of Asia? Not at all, right? I mean, I think Asia's got a great story in terms of the AI CapEx boom. It's got a great story in terms of remember, the big country there is China. Mm-hmm. China has been in a lockdown for the last 5 years, right? They came out far longer from the pandemic. It took them longer to kind of open the economy. And they had a tech crackdown. They had all these types of things. Chinese equities have been in exile for a long time.
So it's ready.
So it's ready. It's primed, right? It's primed for a cyclical update.
And I want to get in Latin America as well. What are your thoughts on that?
Well, Latin America is so there's a really simple rule with Latin America. Is there a commodity boom going on? If yes, then you buy Brazil, you buy Chile, you buy all that. That's kind of the joke around our office, right? It's like commodity boom equals Latin American boom. So Latin America's kind of got this unique sort of place in the global economy where it's not as impacted by tariffs. It supplies a lot of the things that we need for defense, for reindustrialization, for decarbonization. Like Chile is the largest copper producer in the world. Brazil produces a bunch of iron ore. And so Latin America is actually well placed. And we always think about Latin America as kind of an economic basket case, and they can't get their politics right and everything like that. But it does boom when commodities boom. That's sort of the lesson from history.
All right, we're going to take a break on that note there, but we've got lots to talk about, including up next, Linamar reporting another quarter of higher sales. We'll speak to its CEO on that and more. Stay with us. Take a quick look at the markets, see how things are shaping up right now. We'll start with U.S. futures. And in the green again today after that big day yesterday. The optimism carrying through. We'll see what happens today when the markets actually open. Now the Asian markets, take a look at this. Look at the Nikkei. It was up 5.6%. I was looking at it, taking a closer look at it. Closed for a holiday, so they were doing some makeup. But Hang Seng as well, still up 1.5%. And the CSI by about 0.5 point as well. Europe, though, it'll bounce back from yesterday. You're taking some profit. You can see everybody is off. FTSE by 0.6, CAC 40 by 0.25, and the DAX by about 0.2% roughly. And the TSX yesterday, it like everybody else rallied yesterday, up 1.25%. We'll say pushing towards that 34,000 barrier and see if it gets through it. Some of the winners and losers from yesterday, from a percentage standpoint. Sprott was leading the way. It was up 20% and nearly 20%. America's Gold and Silver, the same. Take a look at that, up by a 17.5% as we look at that. Shares doing nicely. Trading volume was up as well. Going the other way, though, IA Financial taking a hit, down 9.5%. The shares declined. The stock was one of the worst performers among its peers. And one other to mention here, Vermilion Energy down by nearly 13% after the company reported a Q1 loss, missing analyst expectations and swinging from a profit a year earlier. Taking a look at metals, gold is surging again. It's up 1.28% to 47.54 right now. Silver as well. Look at the jump on it. It's up nearly 6% and pushing 82 after being in the 70s for the last little while. Copper also big jump there and up by nearly a half at 622. Taking a look at the oil, and you can see the drop there, noticeable. That was from yesterday for Western Canadian Select, another down day, nearly 8%, down below 75 a barrel. And today, WTI was trading down, still is. It's at down nearly 4%, 3 3/4 at 91.50 roughly. All right, Linamar reported sales that beat estimates yesterday. The Ontario-based company says sales increased around 16% for its first quarter, reaching nearly $3 billion. Here to discuss its latest report and more is Jim Jarrell, CEO and President of Linamar. Jim, thanks very much for joining us.
Yeah, morning. Great to be here.
We appreciate it. Nice jump for your sales. Where did that come from? Where did you see the success the most?
Yeah, I think there's probably a few things that really helped us get there. We did 3 mobility acquisitions, in fact, last year of some distressed assets, and day one, they're all 3 are accretive. So that played a big role in our mobility sector. These are great technology companies that were distressed, and we were able to sort of bring the Linamar way into them. And then also we had great launches in mobility, and then also Skyjack, great volumes on the Skyjack side. So I think those were the 3 sort of things that really helped us, get to that close to $3 billion, which again was, this was Q1 record sales, record EPS, record new business wins. So we're really, really proud of the team, what we accomplished in Q1.
Yeah, Jim, Tyler Morty here. I'm a global macro investor and guest hosting this today. So just a couple questions. In terms of I'm really interested in the currency aspect of this report. In terms of the Canadian dollar and how you think about that, I guess a 2-part question. The first part would be, the Canadian dollar has obviously been low. It's been 73 cents. It's been sluggish. It doesn't seem to get off the mat. How has that helped your top line sales? And then the second part of that is do you folks take a hedging program? Do you think about, do you call currencies? Do you think about those in terms of your overall projections?
Yeah, we definitely have a hedging program. In fact, I think in Q1 here, I think we had some negative hit on the currency side, but obviously offset by the hedging program that we did. And it was really, I think the U.S., for us, the U.S. dollar weakened a bit against the Canadian and the peso, which we have a lot of, exchange going on those currencies. But yeah, for sure, we look at a conservative hedging program to, limit the exposure of the, multiple currencies that we're trading in.
I just want to bring it back to the mobility segment for a minute. You're expecting double-digit growth. Which vehicle platforms technology are you expecting to perform strongest?
Yeah, really the vehicle platforms are not necessarily how we're looking at it. We really look at it based off the driveline, the powertrain, transmission, engine platforms. A lot of, I would say in North America, the swing back to sort of, the truck side, right? There's a lot of focus on that, at this point in time. So really our powertrain driveline would really sort of be playing into those different platforms.
Okay. Just a follow-up question here. So there's now like something like 200 new tariffs are in effect right now. How is your company thinking about tariffs? Are you thinking about the upcoming negotiations with CUSMA? How's that factoring into your business there, Jim?
Yeah, I think, since this whole tariff issue has come in, I think you got to, to win in this environment, first, you got to be comfortable being uncomfortable. And it's like almost, it's almost like a whitewater rafting issue versus a cruise, right? And we have been using the term grit. That's our 2026 main theme, central plot. But, certainly I think what we've come out, like greater than 90% of our Linamar revenues are tariff free. Certainly this latest, steel aluminum 232 tariff, which really went after not just the melt and pour stuff, it went really to the derivative level, now to the product level, over 900 products. And so what we're doing, we have been impacted mainly, in the industrial side, of course. And what we're really looking at is, HS code classifications. The government just came out with some ideas around loan concepts, distribution models, that you can change up, and really looking at low effort, easy to implement, no cost solutions. So an example of that would be, if we have a scissor lift, you take it across the border with a reduced value, you might do the software flashing, you might be doing the calibration there, again, to reduce that level. So really try to do low effort, easy things, because we're not going to move plants, because you guys know this is changing, day to day, week to week. And, to me, with CUSMA now is up for negotiation, both sides need each other. I think eventually we're going to get there. It's just we've got to, work through these, times of uncomfortableness. And we've looked at this as really opportunistic.
And have you looked at the CUSMA negotiations, and have you done some scenarios? Stays the same? We see the CUSMA torn up, or just a Canadian-American segment that been negotiated separately without Mexico. Have you looked at that, and what kind of an impact might that last one have on you if it was either torn up or just U.S.-Canada?
Yeah, I mean, we've looked at a lot of different scenarios, right? Because we have plants in Mexico as well, so it has impact there. We've looked at, just a Canadian, U.S. base. We've looked at it if it's torn up and just sort of stick to where we're at. I mean, so like each one has a mitigation sort of idea, right? The problem is, and I think in business in general, nobody really knows where this is going to go. So, we're encouraging, we got to try and get to a deal. And we need each other. There's no question about that. I think it's our biggest trading partner, and the U.S. as well. I think we really got to get to that deal. But yeah, we look at the scenarios, but it's a changing day to day.
And you mentioned about the industrial segment challenges, agricultural market. How is that looking? Are you seeing a recovery, or what are you bracing for?
No, I think, and I think CNH just came out and basically said, hey, in North America, we're at probably a historical low end. So we still see it soft. A lot of people thought, 26, we're going to see coming out, around now to sort of come up. And quite frankly, I think we're still not seeing that. Like farmers, we're connected to farmers through dealers, and they would like to purchase, right? They actually have the capacity to purchase, but the confidence level is not there because, again, inventories are high, farmer income, input costs, and also a lot of those government incentives have been really slow to pay, mainly in the U.S., right? But they've been slow to pay. So I think there's still, some time around that. There's pent-up demand, of course. And I think we are, in our Salford, Macdon, and Bourgault, we're ready as soon as this thing turns on. We're going to be, in a great position.
Okay, Jim, thanks very much for joining us today. We appreciate it.
Okay, guys, have a great day.
Cheers. Jim Jarrell, CEO and President of Linamar. Up next, we'll be back with Tyler Morty to see why he thinks South Korea is indispensable. We talked a little bit about it. We're going to talk more about it when it comes to the AI ecosystem and why he likes Franklin FTSE South Korea ETF. Time to see what's on the radar for Tyler Morty, CEO and CIO at Four Strong Global Asset Management. And South Korea, we've talked about it quite a bit.
Yep.
Is it for the faint of heart, though?
It's not for the faint of heart. No. It's a market that is in a full parabolic melt up right now.
Yeah.
And I mean, if you like for the audience, for those who think about AI, we're always thinking about the hyperscalers, the semiconductors in the United States. But the entire manufacturing complex, the entire manufacturing ecosystem sits in South Korea and Taiwan, basically. Mm-hmm. South Korea on the memory chips and Taiwan on sort of the more high-end AI sort of brain-thinking chips. And so there is no AI boom without those two countries. And, you know, we're talking about emerging markets and like that. Emerging markets have been dead for 15 years, Roger.
So they're playing catch up right now.
Right? They've just hit a wave, and this is a proper CapEx cycle. And so, you know, investors get excited and they bid up these things, but the earnings estimates keep going up and up and up. And so they're trying to play catch up here. But, you know, I would just caution the viewers that these are, again, not for the faint of heart. There's, you know, there's periods where they get ahead of themselves, of course.
Yeah.
But, you know, the super trend, as we would call it, Four Strong, is well in play. We're in a durable CapEx cycle for AI.
Is this like almost a maturing of that market then? The South Korean market would call it
I think it's sort of fortuitous, right? It's a lucky timing for that market. They happen to produce all these chips, and you know, lo and behold, some of these chips were produced for smartphones or for laptops, and they became very adaptable to AI. And so they're kind of like right place at the right time.
All right, let's talk about Franklin's South Korea ETF.
Yep.
You're keeping an eye on it.
Yeah, we're keeping an eye on it, and we hold in some exposures. It's Flickr, FLKR. Mm-hmm. It's up 200% over the last 1 year, and you know, from the V-shaped rebound out of the Iran war, it's up a lot. But again, it's a critical component of the AI ecosystem, and you know, we're in a bull market for AI. I think nobody disputes that, right?
And it's come back with a vengeance.
It's come back with a vengeance, right? And so the concern, we talked about this earlier, Roger, but the concern was that these countries are oil importing nations, right? South Korea is completely 100% oil importing. Taiwan is as well. Japan is as well. And so you've got these two opposing forces. You've got the bearish view, but I think a lot of people make that mistake, right? When you've got the headlines saying Strait of Hormuz, oil at $200 a barrel, and we've seen what's happened with oil, and they sort of fixate on one macroeconomic variable, when in fact the bigger story was this unfolding AI capex boom. And you know, the underlying demand story really is there's a huge amount of demand for compute, right? That's the real.
It doesn't look like there's
no
away
slowing.
from AI right
you know,
now.
you talk to any suppliers, and we saw some earnings reports overnight. There's just so much demand, right? And so that will continue for some time.
Okay, I want to get to a couple others. Crane Shares, CSI, China Internet ETF, KWEB.
Yeah, I mean, we could talk till midnight about China, right? It's
a lot to talk about.
There's a lot to talk about, but China's come back from the edge of the abyss, right? It was, if you think about the COVID period, they locked down for longer than the rest of the world.
Yeah.
They had this tech crackdown. Jack Ma disappeared from the spotlight. All these sort of behavioral indicators that we saw. And China, what was the most synonymous word with China? Uninvestable, right? It's become uninvestable. But you know, we think at our firm, Four Strong, that these companies, Tencent, Alibaba, Baidu, they do the same things that the Mag 7 do, right? They're suppliers of consumer internet services, right? And in fact, they have a bit of an advantage in that within Chinese society, the technology is just the network effects are just so much larger. There's so much integration into the population there. And so, you know, they're doing the same things that Mag 7 is doing. They're trading at about half the multiples of the Mag 7. And it's a play on the rise of the Chinese consumer, right?
And no concerns about the Chinese government?
Of course, there's always concerns about that, right? I mean, it's you know, there's concerns about lots of governments around the world, right?
Yeah.
But the one thing about the Chinese is that they're very predictable in their policies. And the big thrust out of China now has been their industrial policy. Like you look at what's happened in the auto manufacturing sector. It's like the largest car exports in the world. 8 million cars exported last year versus like 3 for South Korea, 4 for Japan, those types of numbers. So China has moved up the value scale. And this concept of China being a supplier of cheap goods is kind of old school, right? China is just moving into like, you know, you look at industry after industry, whether it's autos, whether it's solar panels, whether it's heavy machinery. China's moving up that value scale.
Well, they're leading the green revolution.
Green revolution, yeah, exactly. And you know, I heard the stat the other day: 50% of the autos produced in China now are EVs.
Yeah.
Right. So the decarbonization and the
people are buying them. All right, let's get the last one in. Global X Copper Miners, COPEX.
Yeah, so this is an ETF that supplies exposure to all the major copper producers around the world. A lot of that's in Canada, about 38%. But copper sits at the center of everything. Like if we talk about all the major trends today, rise in defense spending, deglobalization with re-engineering of supply chains,
data centers,
the AI capex, data centers. Copper is just one of those things. So we think this is a strategic holding for clients. It's a long-term holding. It's done pretty well this year. It's up about 16-17% this year. It did well last year. But you've seen the prices of copper. We're in a new commodity bull market. And effectively, a good way to think about this is that commodity cycles are effectively capex cycles, right? And capex, I mean, we've talked about
build. You got to build with something, right?
Defense, supply chains, AI, all those things aren't going away. So if you think those are going away, don't buy this ETF. If you think they're here to stay, then it's something you should have in your portfolio.
All right, we're going to take a break on that note there. But still ahead, we're talking emerging markets, and they've been leading global returns. I don't know about quietly, but they've been leading 2026. It's being driven by structural forces reshaping the world economy. We'll have more on it after the break. And of course, our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. Nutrien posted first quarter earnings that missed analyst expectations despite growth in sales and fertilizer demand. The company saw revenue rise sharply from a year ago, driven by higher sales across its retail potash, nitrogen, and phosphate businesses. Fertilizer prices rose during the quarter, led by a surge in nitrogen costs as global supplies tightened due to the Middle East conflict. Sherritt International is suspending participation in its joint venture in Cuba following expanded U.S. sanctions under the Trump administration. The company says it has not been formally designated under the executive order, but notes such a designation could occur at any time. Sherritt says it is bringing employees back from Cuba, and there is currently no immediate impact on its Canadian operations. The federal government projected a nearly $67 billion deficit for 25-26 in its latest economic update, almost $12 billion lower than the previous estimate. The update outlines several measures, including spending billions on training and hiring skilled trade workers. Still, there are some concerns the deficit room is being used to spend more. BNN Bloomberg's Amanda Lang spoke with Finance Minister François-Philippe Champagne and he says that given the fog of uncertainty, the move is to help Canadians in a time of need.
The concern of people is affordability. I think we have demonstrated we are a good fiscal manager. We have restored fiscal discipline, but at the same time, you have to be where people are. I mean, if we were to go on the street, the concern of people is affordable homes, it's grocery, and it's gas. So we've used, we had $7 billion of additional revenues. We used about 2/3 of that to help people now. We struck the right balance between using some of these revenues to help people, but also to reduce the deficit.
And taking a quick look at the U.S. futures, you can see still positive territory after that surge yesterday. NASDAQ up by 0.1, 0.21, and then the S&P 500 by 0.17. Emerging markets have become a standout source of performance, driven by deeper structural shifts in the global economy. Increasingly, the forces shaping growth and innovation are concentrated in these markets, offering broad exposure to long-term global transformation. Now, Tyler, I'm bringing you back in for a second. We're going to talk.
No
we're talking India right now, and it's not one that's always on people's radar, is it? It's an interesting place.
Yeah. Well, I think Roger, the last emerging markets boom was all built around China, right? China from 2002 to 2012 brought 500 million workers into the global economy, and it was a star outperformer. But what ended up happening is India was the real beneficiary of that. India has been the darling of the emerging markets for a long time. And now India is actually suffering two blows. It's suffering one, this is a 100% oil importing nation, so it's suffering from the higher energy prices as a result of this war. And it's suffering from, if you think of this SaaS apocalypse that we talk about, if you think about AI, what it has in its crosshairs, think about India. what do you think of when you think about Indian
Call
economy?
centers,
Call centers,
software, IT,
exactly.
coding, all that.
So India is right in the crosshairs of AI right now. And it's expensive as a market because people have loved that market. And, we used to be able to say, okay, India's got young demographics, it's English speaking, it fits well within global commerce, all these types of things. All those are true, and all those are true longer term. But in the short term here, with what's trending in markets, it's a market we want to avoid.
And is it a market that, does it feel like they could be adapting to the AI and bringing it in? Or
I think so. But
it may take longer?
Yeah, but it's sort of, if you think about the three sectors of the AI, there's the hyperscalers, there's the software, and there's the semiconductors.
Yeah.
Software is getting killed right now, right? And, we don't know the terminal values of that. So India is kind of a metaphor for one of these software companies. So I think they will adapt over the long term. And India still has a lot of great things about it, right? Not least which is young demographics. Yeah. It never really started a proper infrastructure capex cycle like China did. And so if India can ever get its act together, which I think it will eventually, it'll be a great long-term story. But just, it's the momentum is terrible in the market. It's expensive, and it's got this AI overhang. So we're avoiding it for our clients.
What would you like to see from it to get you interested again? Like how much with the capex cycle?
You need a macro catalyst, right? That's what we say at Four Strong. You need a macro catalyst or macro lever that sort of. I think you'd want to see, a capex cycle start to unfold in earnest. You'd want to see earnings start to turn up. And there's just, sometimes you don't know, you just don't know what the catalyst will be.
Yeah.
But there's no obvious catalyst to get investors back into India. So we talked about China earlier, but emerging markets are kind of like a zero-sum game. It's like you take some money from India to put into China or to put into South Korea. And, largely speaking, it's a heavily rotational market and country rotational market.
And it's just a genuinely interesting place.
Yeah.
Have you ever talked to people there and worked with them?
Of course, yeah.
Yeah.
I travel a lot, yeah.
And what's it like dealing and meeting with the people there?
In India or?
Yeah, in India.
They're all English speaking.
Yeah.
As I say, they fit in well with global commerce. That's great. But each country has its nuance, right? Like I've spent more time in China, but each country has its nuance. But by and large, Roger, the emerging world is full of hardworking, generally young people that want to, and if you think about like the rise in household income, once you pass these critical thresholds, like $10,000 per household, then you start to get TVs and washing machines and all these types of things, and it brings these people into the global economy. So emerging markets have always been a story about the rise and innovation of our species, right?
Yeah.
There's this entire portion of the world, roughly 3 billion people, that don't have all the trappings of that Western consumers have. And so that's always been the bullish story. So we look for those stories. But right now, AI and the CapEx stories is definitely dominating emerging markets.
And the opportunity is not there yet. All right, got to take a break right now, but still ahead. Boardwalk Real Estate Investment Trust has reported a key measure of profitability in its first quarter. Our conversation with the CEO when we come back, and our phone lines are open. And we will be taking your questions on stocks. Call us at 1-855-326-6266 or email firstcall@bellmedia.ca. Boardwalk REIT reported a strong first quarter, citing high demand for rental units in Edmonton. For more on what led to the strength of the quarter, we sat down with Sam Colas, the CEO of Boardwalk.
Edmonton has one of the lowest rents in the nation, as does Alberta and Saskatchewan. Credit where it's due, Premier Daniel Smith and Premier Scott Moe keeping rent controls out where the lowest and most affordable rents in the country now exist.
Okay, so the presence in Alberta is big for you. Edmonton is what you're speaking about. Has any of that market been affected by lower immigration numbers in Canada?
It has moderated our adjustments, and we're seeing more inflationary adjustments. And over the last 20, 30, 40 years, rents essentially track consumer price index and inflation. So we're right on track with that now.
What's occupancy like for Alberta and for some of your other markets in other regions?
Well, one of the highest vacancies in the nation is Calgary, again, because of our competitive market and the public policy of no rent controls. There's a lot of investment, a lot of competition, a lot of choices right now. More on the higher, more expensive, newly constructed apartment rentals. And so with the higher rents, the vacancy's higher at that category. With the lower rents, that our average is around 1,600 portfolio wide, we're still seeing demand and slight consumer price index adjustments.
Would you say that vacancy is higher since the lowered immigration numbers?
Oh, yes, absolutely. The demand has dropped because of international immigration, and we need a positive population growth. We're advocates of a stronger economy that requires positive population growth. We have a lot of housing now, Mirella, and room for new migrants, and so it's time to be more balanced with our immigration policy.
Clearly, you may get a tailwind from nation-building projects. We have a prime minister who's very interested in making Canada a superpower for energy. What could that look like for you?
Well, for everybody, Mirella, we need as a nation to be energy independent. And the best case example is our American brethren and sisters south of the border. Since the United States has become energy independent, they've never really looked back at a recession. And so we have to make Eastern Canada energy independent. We have to connect our coast to coast to coast with our energy.
Sam,
more affordable energy creates more affordable manufacturing and a stronger economy. Energy is critical for economic success. ESG equals energy security equals GDP growth.
And you would get a lot of benefit from workers moving into the Alberta market to help build out some of those projects.
Yes, the white-collar planning jobs that are going to start off with the mega projects, and then jobs coast to coast, because more affordable energy and connecting our nation with affordable Western Canadian produced energy is going to be great for manufacturing in all of Canada.
Let me ask you about the spring market. Is there a lot of movement this time, or is fall bigger for you?
Yeah, the spring is very active because it's weather and seasonal dependent. You know, less folks move in the cold winter, January. So right now we're seeing a pickup in demand in inquiries and rentals. So we are seeing a stronger demand right now, yes.
So because things have been changing over the number of years, probably more vacancies now, you mentioned, than before, do you have to offer incentives to renters these days?
We're adjusting our prices and keeping our prices low. Over the last several decades, we've self-regulated and have always moderated our adjustments. We're very resident family member focused. What's great for our resident family members is great for us as well. And so we have self-regulated, and as a result have kept our rents as low as we possibly can, our efficiencies as high as possible, and our turnovers as low as possible. That's our biggest expense. And low turnover, lower expenses, better for our margins and bottom line as well. So it's a win-win-win for everybody.
So, Sam, where do you see the biggest weakness? Where would you have the greatest vacancies? I know you have units, I guess, in BC. You mentioned Alberta, Ontario as well. Is there one part of the country that at this point is weaker than others?
Well, we have strategically focused in on really large, on average, 2-bedroom unit sizes. And so they're well located as well by hospitals, offices, schools, transportation, and large apartments are really hard and very expensive to build and replicate. So there's a lot of oversupply of very small, newly built and expensive apartments. That's where we're seeing a lot of the vacancy. We haven't built or bought apartments like that. We typically build large unit sizes, like the one we just finished in Victoria, that's renting really well, and a reflection of the demand for large apartments at a very reasonable and competitive relative value in locations where houses are over $1 million. So renting at $2,500, $3,000 a month is compelling and really great value that is relative versus other choices in that more expensive housing market.
Sam Colas, the CEO of Boardwalk REIT. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a downgrade on Tourmaline Oil. Let's take a look now at some of the notable analyst calls and recommendations. BMO Capital analyst downgraded First Capital REIT to market perform from outperform, while raising the price target to $24.20 from $22. The downgrade reflects the company's acquisition by Choice Properties REIT and Kingset Capital. BMO views the proposed transaction as a favorable outcome for unit holders. Tourmaline Oil gets 2 analyst downgrades, with BMO Capital Markets analysts cutting the stock to market perform from outperform. BMO raised its price target to 70 from 67, but said there is limited room for further multiple expansion given the stock's large premium to peers. Separately, Canaccord Genuity analyst downgraded Tourmaline to hold from buy. Canaccord maintaining its $70 price target, saying the shares appear fairly valued. And Fortinet shares are rising in the pre-market trading as the company's earnings forecast comes in above analysts' expectations. The company also raised its full-year revenue outlook, analysts saying the strong results were mainly driven by growth in Fortinet's hardware business. Some analysts noted that enterprise and government customers benefited from bundled pricing, especially during memory shortages. Others said hardware strength helped offset slower growth in service revenue, while improved outlook and higher prices could support growth in 2026. And when we come back, Tyler Morty takes your questions on global investing on First Call. Time for First Call and first email, and that comes from Umesh, who says, what is your guest's opinion of investing in uranium and nuclear stocks for a 5-year hold, as the need for increased energy demand, specifically electrification, is growing?
I love these questions on 5-year holds because they're not, what's your opinion on the next 3 or 6 months? But
or tomorrow.
Or tomorrow, right.
Buy today, trade tomorrow.
What's the price tomorrow?
Yeah.
You start from first principles. Are we in a commodity bull market? And the answer is unequivocally yes. We've taught, the entire program we've been talking about this CapEx cycle, whether it's AI, whether it's defense, whether anything like that. And I think, once you get into commodity super cycles, the first stage is always higher prices. And the second stage is always the supply response. And the third stage debottlenecks everything, and then you get the lower prices as a result. So we're moving from stage 1 to stage 2 right now. And part of that will be, companies and governments looking at alternative energies and looking at, transitional energies like nuclear. So nuclear fits right in with this. It's electrification. It fuels all the things, all the macro things we've talked about, whether it's AI, whether it's defense, whether it's supply chain rewiring. So, it's a volatile series. Nuclear is all over the place. But a 5-year hold, we're definitely positive on that.
Because, they don't. It's not like you can plop a nuclear plant down.
No,
in a month or two. It takes some confidence in it.
Yeah, no, exactly. You're completely right on that, Roger. Like the issue. So if you look at commodity markets and how long trending they are, the last one was from the last commodity bull market was from 2002 to about 2012. The one before that was from 1968 to 1980. And the reason why that they're long trending is because prices rise and it takes a long time to do the supply response. Right, and so nuclear is exactly the same way. We've had an amazing amount of nuclear facilities shut down, particularly in Europe over the last few years here. And so it takes a long time to debottleneck those things. So, these are measured in 5, 10, 15 years. So we think we're probably in phase 1 to phase 2 of this commodity super cycle. All
right, let's get another email in. It's from Glenn. I would appreciate your opinion on Global X Copper Producers Index ETF. I like copper, and as a retiree, I need income.
Yeah, this is interesting because we've covered the COPEX ETF. That was one of the stocks on our radar we hold for our clients, which is it's the one without the covered call overlay on that. So as a macro theme, that's probably one of our favorite things is being long copper producers. What the covered call does is it gives you income, but it kind of caps the upside. And so normally for a client that's in a growth phase or for a client that's building wealth and that type of thing, I would not recommend that. For a retiree, I think that makes a lot of sense. You get the income, you get the alignment with the right super trend, and so we'd be supportive of that position for
All right.
retiree.
Let's sneak in one more email before we run out of time. This one's from Brian. Do you think that now is a good time to take a sizable position in the Canadian oil and gas space?
This is a very interesting question because there's a short-term and a long-term answer. So I'll answer with the long-term first. The long-term is that, I mean, as a result of the Strait of Hormuz and the Iran crisis, what do you think countries around the world are going to be doing? Those countries with politically safe, good, deep reserves, that type of thing. Canada ticks all those boxes in spades. Now, we have to get policy to support that, of course.
And that's the big question.
That's the big question. But in the short term, I think things have gotten a little overheated. I don't like that the Strait of Hormuz is headline risk right now. And so I would wait for a better entry point here. But longer term, it's a great play.
All right. I think we'll wrap it up on that note. Tyler, thank you very much for joining us today.
Pleasure to be here, Roger. Thank you.
That is it for us here on The Street. Tyler Morty, CEO and CIO at Four Strong Global Asset Management, was with us today. Lindsay's up next with The Open. Trading gets underway about 30 minutes from now. Have yourself a great day.